Every options trader has losing positions. The professionals make money not because they are always right, but because they manage losing positions differently from everyone else. Most retail traders do one of two things when a trade goes wrong. They close it immediately at the first sign of trouble, or they hold it indefinitely, hoping it recovers. Both approaches are wrong. One cuts winners too early and the other lets losers run too long. The professional approach is a structured decision framework. Evaluate the position, determine whether the trade thesis is still intact, and then choose deliberately between three precise actions: close, hold, or adjust. In this video, I will show you that framework, walk through 5 real losing position scenarios using Apple on Tiger Brokers, and give you a repeatable process for making the right decision every time a trade moves against you, so that losing positions become managed costs rather than account-damaging disasters. The 3 choices when a trade moves against you. Choice 1: close. Exit the position immediately, book the loss at the current price, and free up capital for a new trade with a fresh thesis. This is always the right choice when the original reason for entering the trade no longer exists, when the stock has broken a key level, when earnings have come and gone and your volatility play was wrong, or when the loss has reached your predetermined maximum. Choice 2: hold. Do nothing. Let the position run. This is correct when the trade thesis is unchanged, the position is within its defined risk parameters, and time is working in your favor. A cash-secured put that is still above the short strike with 15 days to expiry does not require action. Theta is still decaying. The stock is still above your level, and the position is working. Choice 3: adjust. Change the structure of the trade, roll the strike, convert to a different strategy, add a hedge, or partially close. Adjust only when you can improve the position's risk-reward without violating the credit test. Defining your maximum loss before you enter. The most important rule. Every options position must have a predetermined exit level set before you enter the trade. 4 debit spreads. Maximum loss is the net debit paid. Set a stop at 50% of the debit. If a $3 debit spread falls to $1.50 in value, close it. Do not wait for full loss. For credit spreads and short options, maximum loss is 2 times the credit received. If you collected $2 on an iron condor spread and the position has moved against you by $4 in unrealized loss, close it. You are now at 2 times credit loss, the empirically validated stop level for credit strategies across decades of data. Without a predetermined stop, you will hold losing positions too long, roll them into larger losses, and eventually realize a loss far exceeding what was acceptable at entry. The predefined stop is the difference between a managed loss of $300 and an unmanaged loss of $800 on the same trade. Adjusting a losing bull call spread. You bought the Apple 180 and 190 bull call spread for $3.50. Apple has fallen to $175, well below your long strike. The spread is now worth 70 cents. You are showing an unrealized loss of $2.80, 80% of your maximum debit. The trade thesis is broken. Apple broke below 180 and is now trending lower. Choice 1: close. Sell the spread for 70 cents, realize the 280 loss, and redeploy. Choice 2: convert to a butterfly. Sell the 180 call you already own, buy 2 of the 175 calls, creating a butterfly centered at 175. This converts a broken bullish position into a neutral structure centered on the current price, but it requires additional capital and complexity. Choice 3: hold. Only valid if Apple has hit a strong technical support at 175 and you have conviction of a recovery above 180 before expiry. With expiry close, there is rarely enough time for a broken spread to recover. Close at 50% of maximum loss, 175 debit, and preserve the remaining capital. Adjusting a losing iron condor, one side threatened. You entered an Apple iron condor. Short strikes at 175 put and 190 call, long strikes at 165 and 200. Net credit, 230. Apple has rallied to 189, approaching the 190 short call with 12 days to expiry. The call spread is showing a mark-to-market loss. Your choices: close the full iron condor for a net debit, lock in a partial loss, roll the call side up, buy back the 190 and 200 call spread, sell the 195 and 205 call spread for a credit. This buys $5 more of room on the upside. Or close only the threatened call side. and leave the profitable put side open to continue collecting theta. If you close just the call spread at a loss of 180 and leave the put spread to expire worthless for a credit of 130, total loss is only 50 cents, 22% of maximum risk, versus closing the full iron condor for potentially a larger combined loss. Surgical partial closure is often the optimal adjustment on a condor where only one wing is threatened. Adjusting a covered call under assignment pressure. You own 100 shares of Apple at 182.50 and sold the 185 covered call for 250. Apple surges to 193, $8 above your short call, with 5 days to expiry. Assignment is now likely or imminent. 3 adjustments. Roll up and out. Buy back the 185 call for $8. Sell the next month 193 call for $350, net debit $450. You gain $8 of upside in exchange for a $450 debit and 1 more month of time. Accept assignment. Your shares are called away at 185. Effective sale price, 185 plus the 250 premium equals 187.50. Apple is at 193. You missed 550 of the rally. Immediately sell a cash-secured put at 190 to re-enter the position and restart the wheel. Convert to a higher strike with a longer expiry. Buy the 200 call 3 months out and sell the weekly calls against it, converting to a diagonal that captures more of the remaining rally. The right adjustment depends on your conviction about Apple's continued upside. Adjusting a losing cash-secured put, approaching assignment. You sold a 30-day Apple 175 put for 180. Apple has fallen to 171, $4 below your strike, with 8 days to expiry. The put is now worth $5.50. 2 critical questions before adjusting. Do you want to own 100 shares of Apple at 171? And do you still believe Apple will recover? If yes to both, take assignment at 175. Your effective cost after premium, 173.20. Apple is at 171. You are immediately $2.30 below effective cost. Switch to the wheel. Sell the 30-day 175 covered call for 150, collecting income while waiting for Apple to recover. If no, close the put for 550, realize a 370 loss, and do not add a bad position to a broken thesis. If unsure, roll the put down and out, buy back the 175 put for 550, sell the next 45-day 170 put for $2, net debit $350. You lower your assignment price to 170 and gain 37 more days. On Tiger Brokers, all adjustments are executed through the Position Management panel. Select your open position and choose the adjustment order type relevant to your action. For closing, select Close Position. Tiger automatically populates the opposing order at the current market price. Enter a limit order at the mid price for the current bid and ask. For rolling, use the roll order function. Enter the new strike and expiry for the open leg, and Tiger calculates the net credit or debit automatically. For partial closure, closing only one side of a spread. Select the specific leg you wish to close independently, being careful not to create an unintended naked position by closing the wrong leg first. On a credit spread, always close the long protective leg last, or close both simultaneously, to avoid momentarily holding a naked short option. Tiger's position management screen shows real-time Greeks, unrealized P&L, and days to expiry for every open position, giving you all the information needed to make the adjustment decision without switching between screens. The adjustment decision tree, a repeatable process. Step 1. Is the trade thesis still valid? If the reason you entered has been invalidated by price action, a news event, or the passage of time, close immediately. Do not adjust a broken thesis. Step 2. Has the loss reached your predetermined stop? 50% of debit for debit spreads, 2 times credit for credit strategies? If yes, close immediately. Never override a predetermined stop. Step 3. Can the adjustment be done for a net credit or at minimum a small defined debit with clear strike improvement? If no, close instead. Step 4. Does the adjusted position still have a realistic probability of profitability given current market conditions? If Apple is trending down strongly, adjusting a put spread lower and lower is not improving your position, it is chasing the trend. Step 5. Is the remaining time to expiry sufficient for the adjustment to work? With fewer than 7 days to expiry, adjustments rarely have enough time to recover value. Close and redeploy into the next cycle with a fresh trade. The partial close, taking risk off without fully exiting. When a position is partially threatened but not fully broken, taking off a portion of the risk can be more effective than adjusting the full position. Example: you have two iron condor contracts on Apple. The call side is threatened but not broken. Instead of rolling both contracts, close one contract entirely, reducing your position from two contracts to one. You now have half the risk remaining. The surviving contract has the same structure, and if Apple continues higher, your maximum loss on the remaining contract is half of what it was. Taking partial profits on a winning side while holding the losing side to expiry is a similar technique. Close the put spread for a profit when it reaches 80% of maximum value, and manage the threatened call spread independently. Partial position management gives you flexibility that full position thinking does not. You can scale out of risk incrementally rather than making an all-or-nothing decision on the full position. The stop loss for options. How to set it correctly. Options do not have the same stop loss mechanics as stocks. You cannot set a percentage stop on a stock price and expect it to properly manage your options position. The correct stop for options is defined in terms of the options premium, not the stock price. For long options and debit spreads. Close when the value falls to 50% of what you paid. You paid $3. Close when the spread is worth $1.50. This captures half the maximum loss and preserves capital for future trades. For short options and credit spreads. Close when your unrealized loss equals 2 times the credit you received. You collected $2. Close if the position shows a $4 unrealized loss. This keeps your average loss manageable across a portfolio of positions. Set these levels before you enter and treat them as automatic exits, not as levels to evaluate and potentially override. The moment you start negotiating with your predetermined stop, you have entered the most dangerous phase of options trading. Sizing positions to make adjustment decisions easier. One of the most underestimated aspects of trade adjustment is position size. If you have your full account in a single large position, adjustment becomes psychologically agonizing. Every decision feels like it will make or break your account. If each position is sized at 1 to 3% of account value, adjustment is clinical. You make the correct decision because no single trade outcome materially changes your situation. For a $50,000 account, maximum $1,500 at risk per iron condor trade. With that constraint, a full loss of $1,500, the worst case, represents 3% of account value. That is recoverable in one good trade. With proper position sizing, you can close losing trades without hesitation because the loss is defined, bounded, and manageable. Oversized positions create the psychological pressure that drives poor adjustment decisions, holding too long, rolling into bigger losses, and doubling down on broken trades. Converting a losing position into a different strategy, the advanced adjustment. Sometimes the best adjustment is not a roll but a strategy conversion. A losing long call can be converted into a bull call spread. Sell a higher strike call against your existing long call, collecting premium that partially offsets your loss and caps your upside. A losing covered call that is deep in the money can be converted into a diagonal. Buy a further out-of-the-money long call at a higher strike to create a bullish hedge against the short call, reducing your assignment risk. A losing iron condor on one side can be converted into a directional spread. Close the unthreatened side and let the spread on the threatened side become a standalone position with more capital to work with. Each conversion changes the break-even, the maximum profit, and the maximum loss of the position. Never convert a losing position into a more complex structure without fully recalculating all three outcomes and confirming that the new position has a valid, positive expectation trade thesis under current market conditions. The complete adjustment framework on one page. Before entry, set your maximum loss level, 50% of debit for long trades, 2 times credit for short trades. Record it. This is your automatic close level. When the trade moves against you, step 1, is the thesis intact? If no, close immediately. If yes, continue. Step 2, has the predetermined stop been hit? If yes, close immediately. If no, continue. Step 3, can you adjust for a net credit? If yes, evaluate the adjustment. If no, choose between hold and close. Step 4, does the adjustment give you a realistic path to profitability? If yes, Execute on Tiger Brokers as a single limit order at net credit. If no, close. Post-adjustment, reset your maximum loss level for the new position structure. Never carry an adjusted position without a new stop level defined. Adjustments are not second chances to recover losses. They are position management decisions that must meet the same standard as a new trade entry. Defined risk, defined thesis, defined exit. Here's what you now know. 1. Every losing position has 3 choices: close, hold, or adjust. Each requires a deliberate decision based on the trade thesis, the predefined stop level, and the realistic probability of improvement. 2. Set your maximum loss before you enter, 50% of debit for long trades, 2 times credit for short positions, and treat it as an automatic exit, not a level to negotiate with. 3. Adjustments must meet the credit test. Roll or convert only when you can collect a net credit or achieve meaningful strike improvement for a justified debit. 4. Partial position management, closing one contract of 2, taking off the winning side while managing the losing side independently, gives you flexibility that all-or-nothing thinking does not. 5. Position size is the foundation of good adjustment decisions. Size positions so that a full loss is recoverable and the decision to close or hold is made on logic, not on the psychological weight of a position that is too large. This concludes Series 2 of the Mathematical Money Options Education Series, 7 strategies, from the Iron Condor through to trade adjustment, building on Series 1's foundation to give you a complete, professional-grade options trading toolkit.